Mukarimaka, everyone, and welcome to this webinar. This is the India market review being done pretty late India time, almost, it's just past 11:30 p.m. India. So wherever you are, good morning, good afternoon, good evening. And this is, I think, after almost a month that we are doing the India market review. Um, a lot could have been expected to happen, but technically speaking, I guess not so much, as we will see. Before going on, as usual, this is to just declare that this is not financial advice. It's a disclaimer, and this webinar is strictly for information and educational purposes only. This is Dr. Musa, and on the screen you have my contact information. Would love to hear from you. Any feedback, suggestions, collaborations are most definitely welcomed. So please do get in touch, and I look forward to hearing from you. And of course, thank you for listening in and participating in this IMR. Well, having said that, let's jump in right away. And we, of course, start with the Nifty, right? So, been since a month back, there has definitely been a recovery in the Nifty, as has been in the rest of the markets. If you have looked at the webinar posted a few hours back today, which was a global market review, you will already know that the Nifty has basically been quite badly underperforming the rest of the world. And there are many reasons to that. But having whatever it is, the recovery has not really been that strong as one would have hoped for, perhaps, and definitely far underperforming the rest of the world. And one of the things that is leading to this underperformance, just to put it up right up front, is what's in front of you on the screen, which is that net foreign investments in the Indian stock markets have been quite negative last several months, uh, even before the Israel-Iran US war started. But what is really surprising this time is that in March, RBI says that we had more FPI outflows than FDI inflows, right? And what has happened, therefore, is that we have a net negative $11.7 billion outflow out of India. Usually, that's pretty unusual. So even though FPIs, the portfolio guys, have been pulling money out, there was a lot of FDI coming in, but this time the FPI outflows have increased. FDI inflows have also increased, but not proportionately, and we now seeing money leaving the country. Now, what that is really doing by this, one of the most important factors apart from crude oil price increases, is of course that the US dollar INR rate has been just going through the roof, and the rupee, this is an inverted scale, has just been depreciating, depreciating, depreciating. We are hit 96, 90 almost, cooled off a little bit to 95.68 now on Friday. But this has been a huge depreciation that's been just going on and on and on and on, right? And if we take it for just even the year that has started, then sort of we have depreciated a good 7-8%, and that is just the not actually more than that. So almost 8.5% depreciation has happened just since the year started. That's the calendar year. Now that's 8% in like 5 months. It's really something to think about, adding to the uh, burden of the imports. And as you know, the Prime Minister of the country came up with certain proposals saying that we should use petrol and diesel less, should travel out or not travel out at all, and to save foreign exchange, and also to say that not to buy gold for a year or more. And also the whole thing about saying that um, fertilizer use should be curtailed so that we can save a lot of money on the fertilizer that we import. Right, so you can see on the screen what the Prime Minister said: prioritize work from home, avoid buying gold, reduce fuel consumption, cut edible oil use, right? Shift to natural farming so that fertilizer use is reduced, buy local, and avoid foreign travel. Now, of course, there are many memes around this and a lot of different opinions, but the whole idea was that there is a real concern because huge outflows, much higher than anticipated on the account of crude oil price increase globally, and we need to save that. And of course, gold. India imports most of its gold that it consumes, and gold prices have gone up in the last 1 year or 2 years tremendously, as we all know. So, from a perspective of trying to save all that, how much the country is going to follow is an open question. But yeah, so this is one thing, and like I said, the money flowing out, if the FPI is ditching India for all sorts of reasons, slowing growth, fiscal deficit issues, the Middle East tensions, rising interest rates in the US is another reason. So money goes back to a place where you're getting a higher in return for zero risk. Now, all this is putting tremendous pressure on the Indian markets, and that's why the Nifty more or less, still uh, down about 9%, 10% from its peak. While, like we said in the global market review, the many of the Western economies and some of the Southeast Asian, Korea, South Korea, Japan, Taiwan, Hong Kong, etc., are doing, much, much, much better than what India is doing. Definitely most of Europe, or rather all of Europe, perhaps, right? So this underperformance specifically to India, and just connecting this whole thing with how the um, things are for the foreign investors. This is the Nasdaq India index, and you can see that the Nasdaq India index is 22% down from its peak, and this peak was happening in July of 25. Okay, June, July of 25, and in terms of if you're a foreign investor in India, India has not really been rewarding at all in the last 1 to 2 years. If we look at a longer time frame, then it sort of peaked in October 24, and after that, basically, it's been down a good 25% from that. So we are almost talking about 1.5 years that we can almost say 2 years of underperformance in the Indian market from a US dollar perspective. But from a rupee perspective, things obviously looking much better with a nice double top that has happened in the similar time frames. And that double top at around 26,295, 300, significant resistance. And as of now, no sign that the Indian market, Nifty at least, is any hurry to go up on an overall basis, right? And if we look at the broader market, right, so CNX 500, more or less the same thing. A bigger, a little bit of a underperformance there because the CNX 500 did not reach back to its life high of July 24, but still the sideways 1.5, 2 years correction is very much seen across the board, right? So across any of the mid cap, market cap stocks. So uh, Nifty, the broad market, all really not showing any broad-based strength at all. Um, Now, like I said, on account of various fundamental factors, and if we now jump into the individual sectoral indices, we're going to see where the pain points are. Bank Nifty, what you're seeing now on the screen, right, is something that, again, underperforming the overall market, more or less in line with the Nifty itself. But what's interesting is a change that has happened. If you have been following the India market reviews, you would remember that we had mentioned in the last few India market reviews that the PSU banks had been doing well. And what we had basically pointed out is this difference in how the PSU banks had recovered versus the public sector, private sector banks, in the sense that the PSU banks, after the fall of March, went up much more than the uh, private sector banks, the PSU bank index crossing its significant long-term moving averages, while the private sector bank index was struggling and is still continues to struggle. However, what has shifted in the last 2, 3 weeks, 1 month, is that the PSU bank, now if you look at the private sector bank index, the low was in 1st of April around 24,180, but even now the Nifty private sector bank 25,820, right? So that's a recovery, you could say, of about 7.5%, right? But if you look at the PSU banks, well, you see that they are now back to where they were. So this is a significant underperformance by the PSU banks now, right? The private sector banks have definitely done better in the last 1 month. Is this a double bottom in the public sector bank space? Could very likely be, right? But of course, we have to wait and watch and see whether that double bottom holds, or we're going to see further erosions. Mm, just looking at the longer term charts, I am thinking that the PSU banks probably have some more downside left, right? Uh, just looking at the monthly, weekly performance and just looking at how the setups are, the private sector banks definitely showing strength versus the PSU banks, right? So the PSU banks could dip a little lower before they find a base, at least in the next 1 or 2 weeks that we are um, uh, in the next 1 or 2 week time horizon, right? Okay, so this reversal of fortunes, as if you look at it from the very long term perspective, it is the private sector banks that tend to do better, and that situation is now back to what is normal in the Indian stock market, right? PSU banks versus the private sector banks behavior. And moving on to the CNX IT, well, this was a big disappointment in the sense that we already know that the fall was happening, as mentioned in the previous IMRs, even before the Middle East conflict broke out. The AI scare had set in, and the CNX IT index was already down 30%. And then it had this very, very textbook head and shoulder top complex left shoulder, big head, double right shoulder, and this neckline is clearly broken. Now, if you go by the measuring implications, definitely this has not met that measuring implication at all. Just spotted important support that must be watched out for in the coming uh, days, coming weeks, as far as the CNX IT is concerned. Came almost there, as you can see, and has maybe bounced off with the weekly RSI definitely oversold after all. It hasn't seen these levels for, I think, a long time, right? Yep. This last time this level was seen was in 2020 during the COVID fall. So from a pure technical basis, it is possible that the IT index is maybe forming a base. Too early to say, but what is clear is that it broke below the March lows that it made and went lower, March and the April lows. So the IT index had some recovery, but clearly that was just a bounce. There's probably still some pain left in the CNX IT space. The many of the frontline IT companies have done quite badly, but there are some, exceptions, and one exception to really point out is OFSS, which has just been, rallying, 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 and it's quite possible that it's going back in a hurry to its life high. Another one which, if I remember correctly, is persistent. Yes, because this didn't break its previous low and has managed to hold on to it. But many of the other frontline stocks have really broken down. Is in fee for you, right? Could not just maintain it. Broke down quite a bit in April itself, and then went down lower. They all seem to be, recovering right now. If I put TCS, the big brother of them all, that also broke down. So the big daddies of the IT space are really, really struggling. There is a big, uh, you could say, disruption that is happening in the market. The TCS is down almost 50% from its life high of about 4,600 to about 2,300, right? But is it possible that they are now bottomed out? Too early to say, but this is something to keep in mind, that another reason why the Indian Nifty index is really struggling is because one of the big components of the market, the Nifty index, the IT pack itself, is under quite significant pressure, right? And dragging the market down with it. Like I said, some exceptions are there, but overall dragging the market down. The auto index has recovered, not really slipped as much as the other indices have. Stuck between most of its long-term moving averages. One one big mover in this whole space has been TMPV, Tata Motors Private Vehicles. Some recovery in its business and cost cutting, etc. And as you can see, it's done well for itself in terms of um, the technical side. And if you look at the earnings side, there was a big surprise in of 52% in the earnings, which is huge, right? Which is a big, big surprise. What was also a surprise is the revenue had slipped, but the earnings have significantly improved. So some sort of a fundamental recovery, perhaps you could say, happening in TMPV. Just some stocks that stood out in the last 1 or 2 weeks is what I'm mentioning, so that one can follow up. Now, coming to some really, really good news, perhaps for those of us who are looking at it, the metal space has done really, really well, right? So the metal space, which was down 25% from its, life high, there you go, has recovered to the previous life high, and not only that, has gone beyond that. So this is one sector within the Nifty, within the overall market, that has done exceptionally well, right? So the previous life high for the metal index was around 12,440, went all the way to 13,600, has seen this big, significant bearish engulfing candle there right on top, right? And that's quite a large one which is there. So, and then you're seeing all these small bodied candles which are appearing. So there could be some amount of weakness that sets in, or the market takes a pause, the metal space. So watch out for that. But metal probably has still more upside left. Global metal prices are still increasing, and including in India, aluminium, copper, etc., are still on the upswing. So the metal companies are definitely doing well. Probably good quarterly results coming up, and that's probably showing up in the market. Is there some upside? Probably yes, right? There is probably still some upside in the metal space. So just to point out, so while the CNX IT has been dragging the market down with its underperformance, the metal index, on the other hand, is the one which is dragging the market, pulling the market up. And joining the metal index in taking the market up, just to get the point home, is the pharma side. And the pharma index has not only recovered but also gone up quite meaningfully from its previous life high of 23,300 to 25,000. A bit of a correction that's happening after being oversold, or sorry, overbought on the on the daily time frame, and bit of a correction that's happening. But across the board, if you see the pharma companies, some are of course laggards, but some of them are making new life highs, and so is the pharma index. So uh, definitely, the two very opposite sides of the market that are there. If you look at the FMCG index, that has recovered and stayed up, right? It was one of the indices that had fallen the most, and it's peaked out. It had peaked out way before any of these recent crises happened. It had peaked out in September 24 and then continued to go down, found some good support in a place which made a top in July 23. So looks like further downside on the FMCG side is very unlikely, and it is showing a flag type pattern on the weekly chart. You can see that also on the mm, daily chart here, right? A good recovery, probably a flag, good support from some long-term moving averages, and some FMCG stocks are likely to move up in the coming week or two, right? So watch for some congestion there with the 200-day moving average sitting right up there. But FMCG definitely looking good and not correcting as much as some of the other indices have, right? Then coming to oil and gas, so this has been a pretty mixed bag in the sense that all the oil and gas companies in India were under tremendous pressure with the government of India not allowing them to increase their retail fuel prices. There was an uptick, that happened in 20th of May, once all the big elections got over and the West Bengal BJP government was sworn in, and it was expected that fuel prices would be hiked, which did happen. So there have now been four hikes, three or four, 3 rupees, 1 rupee, 1 rupee, right, of both diesel and petrol. So all said and done, it's okay, but the hikes need to be much more for the oil and gas company to recover their losses. If that happens, then one could look at HPCL, BPCL for signs of further up move. But for now, a bit constrained and stuck between the moving averages, right? So there, if you, however, look at a broader market, which is the CNX Energy, so the oil and gas has only oil and gas companies, but the CNX Energy is something that we had mentioned very clearly in the previous India market review. We said it's got this significant resistance, which was most likely to break out of. It did. So it broke out of around 36,600, went all the way up to 41,400, 41,200. So that was a good breakout over a month. And if you were following this, you definitely um, have made some money. Congratulations to all those who did. Just on just to point out something that I should have put in the earlier IMR, but I didn't. That's like an ascending triangle, isn't it? Right? And a good technical picture that is there. And on the breakout, you've also got volume. So all this, look at the energy side, not the oil and gas side. So the other stocks, the non-oil and gas stocks, which are there in the CNX energy index, and you're going to definitely find opportunities. It's again forming a flag type formation, taken a pause for, well, you could say the whole of May, right? After having an excellent April, May, right? And then probably, headed up back to its life high and beyond. Just go back to how the metals and the pharma have behaved. Just putting the pharma back again because I'm just remembering something. Right. Okay. Yeah. This is what I remembered. So the pharma index, similar ascending triangle, but definitely not the exact same. You have that's another sort of a double resistance, and it really broke out. That it broke out of its life high also at that level, and then continued to go up, and an ascending triangle that you can see there, which is what we are seeing in the CNX energy space, right? So remove the oil and gas companies from there and then watch. Having said that, the oil and gas companies, if they have lagged, obviously they have lagged, would perhaps be the ones to look out for the next, 1 week, 1 month, 3 months, if the government of India continues to increase their prices, and if there's an aggressive increase, or if global crude oil prices really cool off. There was some news today saying that progress has been made on the Iran-US discussions. Who knows, right? So that's another overhang which is keeping the markets a little depressed. CNX Infra double top made in September 24 and Jan 26 might try to move up, right? So let's see how that pans out. Nothing compelling there. Would say that there's a ascending triangle here. Could you, with this double top there and this higher bottom here? So something to watch out for. The reality index really getting pressured, right? Had a good run in 2024, and of course, been a nice recovery after its fall in January, February, March, but still under pressure, right? And not something that might go up in a hurry. If crude oil, inflation, etc., moves up, and if who knows down the road, the RBI increases interest rates, then this is a sector that could definitely get hit, right? And if there's a economic slowdown, which many people are expecting, you've got the fiscal deficit, you've got the rupee devaluation, you've got a rather larger than planned for fiscal deficit, you've got the rupee devaluation. All these are going to put pressure on the overall economy, and that would definitely have inflationary pressure that the RBI would then, want to curtail and press down on. The way they would do that is increase the interest rates, and then that would affect borrowing capacity for people who are uh, buying real estate. So there could be a dampening of the demand. So just be wary of that. From purely a technical perspective, long way to go of its life high of 2008, and that'll be really something. 20 years later, if it happens another 1.5 years, to watch out for. But yes, this is another index which you sort of dragging the index down, overall market sentiment down. Rest of the pack, really nothing much to talk about. We have the CNX service index, again, cooled off, going in line with the market. We have media, which is like been chronically down for years now, as you can see on the top left. Not something that has shown any sign of recovery. This is not a sector you want to be in. If anything, exit and redeploy your money elsewhere, right? Coming to public sector enterprises versus MNCs. So the CPSE is doing well. Again, you see this. This is the pattern that is repeating in quite a few indices, and you can, really learn from this in terms of how those indices for the long-term investor patience. You wait for the breakout, or if you're convinced it is, you get in. Now it's formed a double top, the CPSE index, and if it can break out of that double top, then we'll have a big move that can happen. Probably a little bit more cooling that is going to happen in the CPSE index, and then we could see it making an attempt to make new life highs. So the public sector enterprises index overall, right? Again, you can see this pattern, ascending type triangle. This time the fit is not going to be so good and not from the previous. So a weak breakout, but this could be used as a test of that breakout. And if this levels hold, then there are companies in this index that could attempt to go back up, right? And then come back to the MNC index, right? So that's recovered nicely, almost back to its life high, right? Now showing outperformance compared to the PSE index. And the MNCs could definitely, on the infra side, on the electrical side, with the AI data center boom that is happening in India, a lot of heavy electrical equipment, machinery, transmission, power generation is going to be something that you want to be looking at. And a lot of that technology and high-end, high-quality equipment comes from the MNC engineering company. So, have a look at that as a theme to invest in for the coming weeks and months, right? All right. So with that, we've done our India market review. Um, so to wrap up, Nifty is struggling. If you are a global investor, you want to be looking at other markets, not at India. If you are an Indian investor, we've been saying this for the last 2, 3 months that the overall market is no longer something that is probably going to make money. For the last 2 years, it has not. If you are sector specific, and even better, if you are stock specific, that's where your opportunities are. So the Indian market is definitely something which is of a challenge right now. Many people are and will be left behind, but those of us who can dive deeper, this is just a overview, the India market review that we've done right now, given you clear indications of where one should look and where one will find opportunities, and also where not to look. So if you can concentrate your studies there and find the opportunities and put that money there, and of course track it closely, then I think definitely, not I think, I know that there are many opportunities awaiting for the stock picker, as it were. Right. All right. So with that, we come to the end of the India market review for the weekend of starting 22nd May 2026. Thank you very much for your participation, and I look forward to your feedback, Mokari Maka, and I really hope that we have a profitable week and month ahead. Thank you, and have a good Sunday, have a good week, and see you next time.